A company you've been hearing about for years is finally going public. News headlines are everywhere. Financial influencers call it the investment opportunity of the decade. Social media is flooded with excitement, and millions of people rush to buy shares the moment the stock market opens. For many, it feels like a once-in-a-lifetime chance to invest before the company becomes the next giant success story. But just a few weeks later, reality sets in. The stock price begins to fall. Investors who bought during the excitement are suddenly watching their portfolios turn red, wondering what went wrong. So, should you buy an IPO the moment it goes public? Or is waiting actually the smarter move? The answer may surprise you. An IPO, or initial public offering, is the moment a private company offers its shares to the public for the first time. Before this day, ownership is usually limited to the founders, employees, venture capital firms, and early investors. Once the company goes public, anyone with a brokerage account can become a shareholder. For the company, an IPO is a major milestone. It raises fresh capital to expand the business, invest in new products, pay down debt, or enter new markets. For investors, it's an opportunity to own a piece of a company they believe has a bright future. But here's something many people don't realise. By the time a company reaches the public market, much of its early growth has already happened. Early investors may have supported the company for years before it ever appeared on the stock exchange. The IPO isn't the beginning of the company's journey. It's simply the beginning of public ownership. Yet despite this, IPO day often creates enormous excitement. The media covers every detail. Analysts make predictions. Social media fills with stories of people hoping to strike it rich overnight. This excitement creates one of the most powerful emotions in investing: fear of missing out, or FOMO. People begin thinking, what if this becomes the next huge success and I miss my chance? That fear pushes many investors to buy without asking the most important question: is this company actually worth the price being offered? The stock market doesn't reward excitement. It rewards patience, discipline, and careful analysis. History has shown that IPOs can produce very different outcomes. Some companies reward investors with years of growth and become household names. Others struggle shortly after going public, with their stock prices falling well below their opening price. The reason is simple. A great company isn't always a great investment if you pay too much for it. Sometimes, investors become so excited about future growth that they push the stock price far beyond what the business can realistically justify. Even if the company performs well, the stock may still disappoint because expectations were simply too high. On the other hand, some companies experience early selling pressure, only to recover later as their financial performance proves stronger than expected. This is why experienced investors often choose to wait. Waiting gives the market time to settle. It allows the company to release its first earnings reports as a public business. Investors can evaluate whether management is delivering on its promises instead of relying on marketing and optimism. Another important factor is something called the lock-up period. When a company goes public, early investors and company insiders are often restricted from selling their shares for several months. Once that period ends, many of those shares may enter the market. If a large number of insiders decide to sell, the increased supply can place downward pressure on the stock price. By waiting, investors can observe how the company performs after the excitement fades. Instead of making decisions based on headlines, they can rely on real financial results. Of course, waiting isn't always the right answer. Some IPOs continue climbing for years, rewarding investors who believed in the company's long-term potential from the very beginning. The difference is that successful investors don't buy simply because everyone else is buying. They study the business. They understand how it generates revenue. They evaluate its competitors, leadership, profitability, and long-term strategy. Most importantly, they invest because they believe in the company's future, not because they fear missing out. The truth is, there is no universal rule for every IPO. Some will become incredible success stories. Others will fall far below their opening price. The challenge isn't predicting the future. It's understanding the business well enough to decide whether it's worth owning. The smartest investors know that investing is not a race. There is no prize for buying first. Sometimes acting quickly leads to exceptional returns. Other times, patience becomes your greatest advantage. So the next time a company announces its IPO, don't let excitement decide for you. Take the time to ask a simple question. If no one were talking about this company today, would I still want to own it? Because in the end, successful investing isn't about chasing the newest opportunity. It's about making informed decisions that stand the test of time. And that may be the most valuable investment lesson of all.